What's a balance sheet? And why do you need one for your business? Let's get into it. A balance sheet is one of the most important financial statements for a business. It gives you a snapshot of exactly how much money you have to work with right now and shows you how risky your business is. Okay, but how? In a nutshell, your balance sheet shows you what your business owns, what your business owes, and how much has been invested by owners, reported on a single day, so you can see your business's financial position at a given moment in time. There are three main parts to a balance sheet: assets, liabilities, and equity. Assets are what your business owns of value that can be converted into cash, like money in a bank account, accounts receivable, and inventory. On your balance sheet, assets will be divided into current assets, which are assets you expect to convert to cash within 1 year, and long-term assets, which are assets you don't expect to convert to cash within a year. Liabilities are what you owe to others. Accounts payable, credit card debt, and tax payments are all liabilities. Like assets, liabilities are divided into current liabilities, which must be paid within 1 year, for example, accounts payable, and long-term liabilities. These are payable beyond 1 year. A typical bank loan would be an example of a long-term liability. The third component of a balance sheet is owner's equity. This is the owner's net assets after subtracting any liabilities. Owner's equity is also known as shareholders' equity in a public company, or members' equity for a partnership or LLC. Looking at your balance sheet, you can easily calculate owner's equity by subtracting total liabilities from total assets. Rearrange that equation, and we see that liabilities plus owner's equity is equal to assets. When this equation equals out, your balance sheet is balanced. Now you know what a balance sheet shows, but why do you need it? The data in your balance sheet can help you understand the financial health of your business. How? By giving you a clear picture of your liquidity, efficiency, and leverage. Let's say you need a line of credit for your business. A lender will want proof that you can cover your payment. Or imagine you're faced with a sudden slowdown that drastically reduces your income. You're going to need cash, quick. Your ability to access funds quickly is liquidity. Lenders will want to see your liquidity on paper. And for your own peace of mind, you should know what funds you have accessible for emergencies. How do you calculate liquidity using your balance sheet? Compare current assets to current liabilities. Plenty of liquid assets left over after accounting for liabilities indicates a financially healthy business. Another reason to keep a balance sheet is to measure efficiency. Lenders and investors pay attention to this, and you should too, because efficiency shows how well you're managing your assets. Efficiency is calculated using different efficiency ratios that compare sales, cost of goods sold, and expenses on your income statement to current assets on your balance sheet. Looking at efficiency ratios can give you important insights, like, am I waiting too long to get paid for my work? Am I spending too much to produce goods that aren't selling? Your balance sheet also shows you how much leverage your business has. So what's leverage? Very simply, leverage is using debt to finance your assets. Lots of businesses borrow money to get off the ground or grow. The problem is when your debt far outweighs your equity. Remember, equity is what you have left over after paying what you owe. If your debt-to-equity ratio is out of whack, it could indicate you're facing a lot of financial risk. Nice, you're officially a balance sheet rock star. Now for those in the back, a quick recap.